All right, let's dive right in. Today, we're going to decode the one language that every single business on Earth has to speak. And here's the secret. It's not about complex math, it's about learning to read a story.
So what is this universal language? It's the script that reveals a company's entire life story, its past, its present, and even clues about its future. Yup, you guessed it, it's accounting. And I know that word can sound a little intimidating, but by the end of this, you're not just going to see a bunch of numbers on a page, you're going to see the story behind them. Now, every language has rules, a grammar that holds it all together. And in business, there is one single unbreakable rule that governs absolutely everything. And here it is, the accounting equation. Assets equals liabilities plus owner's equity. Seriously, you can think of this as the E equals MC squared of finance. It must always be in balance, no exceptions. So let's picture it like a scale. On one side, you have assets. That's all the stuff a company owns, its resources. On the other side, you have the claims on that stuff. Part of it is owed to others, like banks. Those are the liabilities. And whatever's left over, that's the owner's piece of the pie. That's their equity. Okay, theory is great, but let's make this real. We're going to follow the story of a brand new startup. We'll call it Investment Advisors Ltd, and we're going to watch its financial story come to life, one step at a time. We're going to watch three huge firsts for any new business: getting the money to start, buying the things they need to sell, and of course, making that very first sale. First things first, funding. The owners put in $150,000 of their own cash. So what happens? Well, the company's assets just shot up by $150,000, right? It's got cash in the bank. And where did that cash come from? The owners. So their claim, the owner's equity, also goes up by the exact same amount. Boom. Perfectly balanced. Next, our startup needs something to sell. It buys $10,000 worth of books, but, and this is key, it buys them on credit. So now it has a new asset, $10,000 of inventory. But since they haven't paid yet, they also have a new debt, an IOU to their supplier. That's a liability. Assets go up by $10K, liabilities go up by $10K. That scale is still perfectly level. And now the fun part, a sale. Now listen closely, because every sale is actually a two-part story. First, the revenue part. The company sells some books for $125, also on credit. Because they've now earned that money, their equity goes up by $125. But they don't have the cash yet, right? They just have a customer's promise to pay. That promise is an asset. So assets are up, equity is up, still balanced. But remember I said two parts? To make that $125, the company had to give something up, the books. Let's say those books cost them $100. Their inventory, which is an asset, goes down by $100. And that cost is an expense, which reduces the owner's equity by $100. So both sides of our equation just went down by the same amount, and it stays perfectly in balance. Okay, so we've been looking at these tiny little transactions, right? The individual brushstrokes. How do we step back and see the whole painting? Well, that's where the financial statements come in. These are the official scoreboards of the business. The first scoreboard is the income statement. It tells you if the company made money over a period of time. You just take your revenue, our $125 sale, and subtract the expenses it took to get it, the $100 cost of the books. What's left is the famous bottom line, net income. In our case, a tidy $25 profit. So what happens to that $25? It doesn't just vanish. This is the crucial part. That profit flows directly back into the company, into a piece of owner's equity called retained earnings. This is the magic link between the company's performance and its overall financial health. You know, the source material we're using explains this perfectly. It says that retained earnings links the as-of balance sheet equation with the activity equation of the income statement. It's the bridge that connects what a company did with what it now has. And this brings us to what might be the single biggest point of confusion for people, the idea that profit is the same thing as cash. Let's clear that up right now. The whole difference comes down to something called accrual accounting. It just means you record revenue when you earn it, not when the cash shows up. And you record expenses when you incur them, not when you pay the bill. The timing of the business activity is what really matters. Here's a perfect example. Imagine our company gets $1,200 cash today for a one-year subscription. Is that a $1,200 profit
Not a chance. They have the cash, which is great, but they've only earned 1 month's worth so far, so they can only count $100 as profit this month. They'll recognize the rest month by month. See? Big cash inflow, but a much smaller initial profit.
So why does all this matter? I mean, why is it so important to master this language? Because sometimes companies use the rules of this language to lie.
Let's look at the infamous case of WorldCom. This quote from the SEC's complaint says it all. They found that WorldCom was hiding its expenses in order to, and here's the T phrase, artificially inflate the income. So how'd they do it? It was actually pretty simple and pretty sneaky. They took a regular, everyday cash payment, like rent, which should have been an expense, reducing their equity, but instead they pretended they were buying a new asset. Now think about it. The accounting equation stayed in balance, but their net income was a total fiction, hiding from everyone how badly the company was actually performing. Understanding these mechanics is like having a secret decoder ring for business. It lets you read between the lines and really question the story you're being told. So I'll leave you with this question. The next time you see a financial statement, are you just going to see numbers, or are you going to see the real story?